Okay, hi there. Let's spend a few minutes thinking about some of the main advantages and also some of the costs and drawbacks of trading goods and services for developing countries. In an exam, don't forget to use appropriate analysis diagrams if you can to show some of the gains from trade in goods and services. Perhaps a diagram showing the reduction of a tariff or a comparative advantage analysis diagram. Now, we're going to focus on developing countries here. Typically, those gains have to be linked to the particular stage of development and industrialization process that a country is at. There's some graphics here which you may want to think about in terms of key gains. I want to take you through some slightly more detailed points in 5 separate points. So one of the advantages of trade is that it can generate foreign currency, be it dollars or Japanese yen or Chinese renminbi. And if you're running a trade surplus, a net injection into your circular flow, then that's going to build up your dollar reserves, and that can help overcome a savings gap. Some countries may even be so successful they can start to establish perhaps a sovereign wealth fund. Think of countries such as Qatar and the UAE. A second really key advantage of trade is that trade is an important way of generating the export receipts, the export revenue, which can help pay for key essential imports. Perhaps a country is a net importer of capital equipment, new technology. Perhaps it's a net importer of energy, such as oil and gas. Well, you need to export enough value of goods and services to pay for those key imports. And those imports could well be crucial to the development process. Trade, of course, successful trade is also an injection of demand into the circular flow, and nothing wrong at all in the exam with developing the idea of export multiplier effects, the multiplier effects kicking in. A rise in exports leads to a bigger increase in national income, accelerator effects because there needs to be an investment in the industries to generate the extra exports. Trade creates jobs in export industries and related sectors, and of course then develop the chain of reasoning. Higher employment and higher incomes can lead to improved trade performance, improved human development scores, greater funds for education and health, and so on. Trade is also a way of making markets more contestable, more competitive by opening up the market, and in that sense trade can bring down the price of goods and services for domestic consumers. So if trade gives people access to cheaper, previously unavailable goods and services, not only do they have more choice, but their real income goes up, and again that can stimulate higher living standards. So in theory, lots of potential advantages, and I guess you'd go back to the theory of comparative advantage and some of the potential gains from specialization, division of labor, trade and exchange. However, you need to be familiar with some of the potential drawbacks, some of the potential costs of trade, specifically for developing countries, emerging market countries, for example. The first key point is oftentimes the prices at which trade takes place are quite volatile. So it could well be the case that a country is an exporter, but only in a relatively small number of products, and the prices of those products globally move up and down. They're very volatile. That can have a direct effect on the terms of trade, can have a big impact on the revenue from exports, the profits of exporting companies, and, crucially, the tax revenues for governments. For developing countries, there are also risks and uncertainties that your export sector will be affected by geopolitical uncertainty. So the extent, for example, to which African countries might be hit by a Chinese-US trade war, or by the impact of the global financial crisis on the access to trade finance. Countries which are highly exposed to the world economy may suffer quite big cyclical shifts in demand, particularly if the world economy goes through some turbulent times. So exposure to external shock is a cost of trade. Another potential cost is that if you open up your markets to free trade, that can cause some structural unemployment, particularly as the pattern of demand changes. You may be losing your manufacturing sector just at the point when it should have been developing. A lot of poor countries initially opt for fast industrialization, perhaps aided by import protectionism, import substitution policies initially, to get their domestic businesses up to scale, and then perhaps they open up to international competition thereafter. Another risk, another downside, is that countries that specialise in only a few natural resources, well, they may of course suffer from the natural resource trap, or sometimes known as the resource curse. Perhaps the value of their commodities go up in price, and that drives the exchange rate up and makes the manufacturing sectors less competitive. It may be that they're an exporter of oil or copper, and suddenly the world price collapses and the revenues they're expecting fall, and if they've borrowed money to fund investment, it just becomes so much harder to repay the debt. And of course, the resource curse is the idea that countries rich in natural resources, extractive resources typically, often end up poorer than countries which export other products. The fifth point is this theme, is it not, running through the entire A level? You can always do well in evaluation if you talk about the possible effects on equity. So trade lifts average incomes, most people think, lifts per capita incomes, but it might also lead to an increase in income and wealth inequality. The gains from trade are rarely, if ever, equitably or evenly spread. Some 3 evaluation points to finish with. Although in most cases economists would argue that there are significant aggregate gains from trade, the research shows that actually the impact of trade on wages and jobs tend to be geographically concentrated, perhaps in coastal areas with a special economic zone or in urban areas. And often parts of a country may miss out from some of the gains from trade, leading to an increase in intra-national inequality. Second point is that trade can bring gains in both static efficiency, productive and allocative efficiency, and also dynamic efficiency. Now, those are significant. Which are the most significant? Probably dynamic, probably the link between trade and innovation and investment and choice. But the efficiency gains, shouldn't be discounted. The most important point for me is that if you're a developing emerging country, in the long term, you have to increase your capacity and your capabilities so that you can diversify your export sectors, perhaps away from primary products towards light manufacturing, or perhaps away from light manufacturing towards financial services or tourism or health and education. Successful countries are competitive in part because they have scale, but also because they have a diversified export base, which makes them less susceptible to global economic fluctuations. The long-term aim for countries is to move into higher value-added industries to gain more of the gains from global trade. Most of the value added doesn't come from extraction. It comes from manufacturing, processing, refining, distribution, and the final selling. So some really key points, hopefully, evaluation points. Trade for developing countries is significant, it's important, and hopefully this video has given you some good advantages and disadvantages to think about.